Zoom stock is down 87% from its all-time high. It's the fifth biggest position of ARK Investments, and Michael Burry sold his position. In this video, I am going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, this company grew a lot during COVID, as they are an online communications company. Since COVID, they have managed to continue to grow revenue, but not at the same pace as before. The revenue growth percentage has decreased from 300% to 3%, and analysts are expecting them to grow between 3 and 9% for the next 5 years. Regarding profit, this is a company with very high margins, with gross margin being between 70 and 80% for the past 5 years. Their net income has suffered, but it seems like a short and temporary problem because analysts are expecting them to recover and their free cash flow is much higher at $1.3 billion. Analysts are expecting them to make $5.50 in 2027. If you assign a 20 PE to the company, it would make it a $110 stock, meaning 54% upside. Then, in order to calculate the intrinsic value of the company, I used my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. The intrinsic value according to free cash flow is higher because I assumed a higher free cash flow margin than profit margin, as it has been a lot higher over the past years. I actually don't mind this because net income is subject to a lot of accounting rules, while free cash flow is simply cash from operations less capital expenditures. And these numbers mean two things. First, that in order to obtain the desired annual return that I have put in, which is 14%, you need to pay these prices. Second, the stock is currently trading at $71 per share. Therefore, if the low assumptions occur, you are going to make a 10% annual return on your money. If the middle assumptions occur, 16%, and if the high assumptions occur, 22%, according to the discounted free cash flow. The Excel spreadsheet does not address any value to the balance sheet, and this company has an exceptional balance sheet because they have a lot of cash and almost no debt. They have $6 billion in cash and only $55 million in debt. This is a lot of cash for a company that has a market cap of $21 billion. One could argue that the company is actually worth $14 billion, which is 33% less. Following this reasoning, the intrinsic value could be 33% more, meaning $103 per share on my middle assumptions. Now, I am going to leave you with Cathie Wood's opinion on Zoom stock before talking about the pros and cons.
I ask you about Zoom.
Yes.
Because I don't understand it, and obviously you know the stock a lot better than we do. But Zoom seems to have been killed by Google Meet. Me personally, when I set a calendar invite, I was only a Zoom user. Now I switched to Google Meet, and the company just reported a couple weeks ago, and they're just not really growing.
Even internally, Salesforce now owns Slack. When we're gonna we have 58 employees. They're all over the country. We're constantly doing impromptu video meets. It's so easy to hit the huddle button in Slack, as opposed to going to Zoom, scheduling a new meeting, adding people's email address.
Right.
So Zoom is the second biggest holding in the innovation fund.
Right.
And what are we missing?
Well, what you were focused on are intra-company dynamics. This is inside your companies. If you look at the share of traffic inter-company, you'll find that, and I think this is it Sensor Tower data? It's one of those services. You'll find that Zoom is at roughly 40%. Microsoft is, I think, at 16%. Microsoft is
Teams is offensively bad.
Yeah,
Teams want you to they want you to download an app before a meeting.
Restart your computer.
Yeah. Anyway, Teams is at 16. Google Meet is low single digits, if I'm not mistaken.
I'm a contrarian.
So yes, you're a contrarian. We like contrarians.
So Zoom still has its share.
It has its share.
But they're
now,
not really growing
critical
that
to
much.
them, they have a partnership with Salesforce.com, right? What happens inter? Inter is where the sales take place, right?
One company to another.
Yes. Now, that's very
Or one
high
organization
value,
to
very
another.
high value add. Now, if you look at the talent that Zoom is attracting, they just attracted someone who had spent 16 years at Google. This is she's the chief product officer. 16 years at Google, I think it was 9 months at Microsoft, and came over to Zoom. So we watch management, we watch where talent goes. They've attracted people from Google, Microsoft, Amazon, many of the other companies. They've got this, I would say, moat. It's theirs to lose on the inter, and they're about to launch a bunch of AI products. And they brought people in to help. Now, we're looking very carefully at that to be sure. Eric Yuan is the founder. He founded WebEx. Cisco bought WebEx. If you think about
the original video conference software,
which has no share now.
Yeah.
So he knew that enterprise communications was going to move from on-prem, hardware-oriented into the cloud.
Yeah.
Okay. This is a $1.3 trillion line item. It is the largest part of the tech stack, enterprise communications. It's moving into the cloud, and who's going to be at the center of this? It will be Microsoft because of Teams and all the enterprises they have. They don't want to be hostage to Microsoft. You have to have some redundancy. So even they will have a failover to something, and others just don't want Microsoft, as you were saying. So this is Zoom's to lose. Now, if they are not, I can tell they have a lot going on, and we're putting a high weight on Eric and the team's ability to activate AI within this ecosystem in a provocative way that helps companies increase their productivity and accelerate sales.
The pros of investing in this company are the balance sheet, the high margins, the high free cash flow, and the valuation. It is trading at a forward PE of 14 and a price to sales of 4. This is good for a software company. If we compare it to Microsoft, which has a similar gross margin, Microsoft is trading at a forward PE of 33 and a price to sales of 13. On the other hand, the cons of investing in this company is the revenue. We have already seen that the revenue is contracting, and I worry about how they can continue to grow because there is nothing sticky about this business model, as there are other platforms that provide similar services. I personally don't own the stock because I am not sure how their business model is going to thrive in the future. However, based purely on numbers, I can see why this might be a good investment. I hope you enjoyed the analysis. Let me know what you think about Zoom in the comments, and I'll see you in the next one.